is going to record the PV of all the payments that he has to make to the lessor over the tenure of the lease. In my example, 4 years, 8 periods. He will discount all of this. Today's date, it is 2,18,860, 116. So I discount all of that. That becomes my beginning liability. Over the next 8 periods, when I'm going to pay you $30,000 every 6 months, some part of it is going to be the interest element, which you're going to calculate the beginning liabilities ratio. And whatever is the balance becomes my reduction of liability. So if I just continue this for all the others, if I continue this for all the others, at the end of 8 periods, my entire liability becomes 0. That means I would have paid the lessor with all the outstanding interest over the 8 periods of lease payment. Is this clear? Everybody, people who were with me when we were doing, notes payable and the effective interest method when we were doing for bonds liability, this is exactly what we did. And for others who've done bonds, ideally, this is a chapter that we do after bonds and the notes payable and long-term liability. Now, see, can you understand one thing here, guys? Why do we call it an effective interest method? Because every year, the interest rate is remaining constant at 2.175%. Even though the amount of interest is changing, every year the lessee is paying the same rate of interest to the lessor. That is why it is called the effective interest method. Had you used the straight line method of discounting, the value would have remained same, but the percentage would have differed. So US GAAP wants you to use the effective interest method for dealing with long-term liabilities, which is greater than a year. Is this clear? Anybody who's not clear with this till now? Is this clear? Now, guys, look at the journal entries. Okay. Now, see what happens. Now, this is what the new leasing standard is asking us to do. First thing what we did, we identified the 2 parties. One was the lessor, another is the lessee. Then we identified the lease. So we used the criteria for lease identification, and we found out that this is an operating lease, both for the lessor as well as for the lessee. Then we worked out the PVs and we calculated the effective interest method. Okay. Now, understand, guys, this is an operating lease, right? That means essentially, property remains of the lessor. The lessee is just paying you rentals every year. So earlier, what we used to do, we used to just call it rent expense to cash, or rent expense to the lessor, and we used to pay the lessor to cash, right? Now what we are asking you to do, now we are asking you to record the asset and the liability. So the first journal entry becomes when you record the asset and the liability at the PV of the lease rentals. Is this clear? Are you understanding what we're doing? The accounting standard wants you as a lessee to recognize the asset, we call it a right of use asset, and to recognize a lease liability of what figure? Of the PV of minimum lease payments that are going to go from the lessee to the lessor. The lessee, on the other hand, is not going to go for discounting. Okay, what we'll do is we'll first finish the lessee's book, then we're going to do the lessor's. Okay, now see what we're doing. We're discounting the entire payments. We are asking the lessee to bring an ROU asset and a long-term liability in the books of the lessee. Then every time when the payment is happening, we are saying that, boss, this is an operating lease. I don't want you to book the interest expense. As simple as that. Remember, the operating expense, if it's an operating lease, I don't want you to call it an interest expense. So you will see that neither the lessee nor the lessor will book any interest expense in their books. All that we want you to do is whatever is the amount that you're paying every month, which in my example is $30,000 every 6 months. The full amount will go away in cash. Do you see this? Since it's an operating lease, which is supposed to be of a relatively shorter duration, and the lessor is continuing to depreciate the asset in his or her books, all that we want from you is to avoid off-balance sheet transactions. So we are going to ask you to bring the asset and the liability in the books at PV. But now think about it like this, guys. We are still carrying the earlier fund of P&L, right? We are just bringing all the expense. Earlier, we used to call it rental expense. Now we're going to call it a lease expense. Remember, nothing called amortization which will go separately. No interest, nothing. There is one expense that will go hit your P&L. We call it lease expense and we will credit cash. But now I have got the asset and the liability in my books. What I want you to do is, if you are a lessee, I don't want you to follow the straight line method. I want you to follow the effective interest method. The same method, I want you to decrease the ROU asset. So you got an asset in your books, you got a liability. You will have to pay the liability and you've got to remove the asset from the book. So everything becomes zero at the end of the lease tenure, right? So what do I tell you? I tell you, amortize the ROU asset on the basis of the lease liability reduction. So every year, whenever the lease principal liability is going away, the same amount I want you to reduce the ROU asset. Do you understand what we're doing, guys? Every year, see, I got a liability in my books, right? Every year, ideally, what is happening? Can you understand? Ideally, if you compare it with bonds, in bonds, what we do? We bring down the liability and then we increase it with the interest element every year and then we pay off the liability at the end of the lease term. Here, in the operating lease, I'm not doing that. I'm saying forget about the interest element. When you pay the expense, go back to your old days, rental days. I'm not going to call it a rent payment. I'm going to call it a lease payment. Simple. I just take my P&L, debit the full expense, not bothering to bifurcate it between depreciation or another thing. I just debit the expense, credit cash. But now, since I've got the asset and the liability in my books, I will reduce both the asset and the liability. How? To the extent of liability reduction. So I will go to the effective interest method. I will construct. Now, do you see this loses its identity. I'm not going to treat it separately in the operating lease. I'm going to forget about the interest element. I'm going to just take the principal reductions. This 218,116, I'm going to reduce my liability and the amortization of the asset will happen at the exact same value. And this we are going to do year on year. So here I'm giving you a snapshot of only 1 year. Again, in the next period, quickly, this is what? Sharad, do you want to take this question? Oh, Sharad is here. Yeah. Sharad, unmute fast.
Sure.
Next year, tell me. I'm taking the next payment, okay?
Yeah.
This payment, 31st
30,000.
December. How much expense I'll be booking in my books?
So 30,000.
Full. Whatever payment
Yes.
I'm making,
Yes.
like the earlier rental, I'm going to just take that full payment and I'm going to debit my expense in the
Cash.
P&L and I'm going to credit cash with the exact same figure. Then how much is the lease liability that I will reduce?
It would be 20. Can you go up? Yeah.
Tell me the
258.
figure.
25805.
And this is the amount by which I'm also
Same.
going to reduce my asset.
Yeah.
Is that clear? So if I
Yes.
tell you at the end of 1 year, what is your total P&L hit? What is your answer?
So expense wise, it would be 60,000 to P&L.
P&L.
And
Very good. What is your total balance sheet reduction of lease liability?
so it would be 25256. Just a minute.
This one. Is this clear?
Yes.
My lease liability will
51016.
reduce. Very good.
Yes.
Very good. Okay, guys, third question. Anybody can answer. I'm leaving it in the chat panel. What should be the balance of lease liability at the end of year 1 in my balance sheet? Just write it in the chat panel. What should be the balance of lease liability at the end of first year in my balance sheet? Yes? Write in the chat panel, guys, fast. Shouldn't take so much of time. Okay. Okay, it is 167.05. Very good. Next question. What is my total interest hit throughout the lease term? What is my total interest hit throughout my lease term? And let's say I don't ask you to calculate all of this. If I just tell you what is my total interest hit, how will you calculate? Can you think, guys, this is actually the delta between what you're going to pay and what you have paid. Yes or no, guys? So actually, it is like saying either you pay me down payment right now. In that case, I will charge you 240, or you can pay me over the next 4 years, carrying the interest element of 21,884. Can you understand this, guys? Everybody? Is this clear? So this becomes my total interest hit throughout the tenure of my lease, which is actually the delta between the actual payout without the interest element and the PV, which is including the interest element. Now, in bonds, what we used to do, we used to record the liability at 218, and we're going to increase it by the interest element by 21,884. Ultimately, the bond value used to become 240, and then we used to pay this to square it off. Yes, no, guys, is this clear? Anybody, any questions? So what we've done the lease classification. Now we've done the operating lease, and we've worked out the journal entries in the books of the lessee. Now, can you see, guys, what is happening? It is actually the earlier thing only. We are only P&L debit, cash credit. The only delta is we are asking you to book the asset and the liability, use the effective method of amortization, reduce the asset and the liability by the effective amortization method. Is this clear? End of the lease term, it becomes all squared off. Anybody, any questions till now? Is this clear? Okay. Now let's go and look at it from the lessee's perspective, guys. Okay, from the lessor's perspective. What is the lessor going to do to account for these in his books? Now think of it like a regular rental contract. Guys, the lessor will either record a sale or we recognize the asset or book it like a regular rental contract. A regular rental contract kya hota? I would have just booked the cash whenever he would have given me the rent, and I would have booked it as rent received. That's it, right? Nothing else. Cash, rent received. Cash, rent received. That's what we are going to do. But we are going to do it in a sophisticated manner, right? So see, there are two ways, guys. Both the ways are equally possible. In some of the books, when you see, they will say just book the cash whenever you get the rental pay. So cash account debit to rent received, which is okay. On the contrary, what you can do is also this. On the day when the contract is entered into, the lessor has a right to receive full $240,000 because that's the value of the entire receivable over the lease term. Isn't this, guys? So I'm supposed to, the moment I enter into a lease contract, I get a right of having a receivable to the tune of 240, and I will book an unearned revenue. It's like rental contract that has been signed, which the lessee cannot avoid. So I will get a right to receive the money, and I will not be able to recognize anything right now in my P&L. Why? Because it is deferred revenue. The moment I get this amount, I'm going to book cash. This is the amount that I'm going to book because that's the first amount that I've got. And I'm going to knock off my lease receivable. Can you see this? What I did? The day when I signed that lease, I recognized, can you see there is no P&L impact? There is only balance sheet impact the day when the lease is signed. Only the balance sheet impact. I will book the receivable, the asset, over the entire tenure of the lease, and I'm not bothered to do the PVs. Remember that. Why? Because I'm not booking any in the P&L, right? So I will book the full amount and I will book the unearned revenue. Then the moment first payment is received, I will reduce the receivable. I will book the cash and I will reduce the receivables. Then what will I do? That proportionate revenue that I booked, I'm going to reverse that revenue and now book it as the actual P&L hit. So what will I do? The same amount, I'm going to reverse it from unearned rental and I'm going to book it as rental revenue. Okay. Now I'm a lessor. Anyways, I was having the asset in my books. What will I do? I will simply now depreciate the asset. How much? The carrying value of the asset is 400. Can you quickly tell me what is the depreciation figure? What is the depreciation figure in the lessor's book on 30th of June? Let's see who gives the right answer. What is the depreciation figure in the lessor book? Wrong. Vishnu. Depreciation figure in the lessor's book on 30th of June. Yes? I've not got a single right answer till now, guys. Only on 30th of wrong, Anirban. I'm saying not in the entire year, Anirban. I'm saying only for the first 6 months, right? The first payment that I'm doing. This is the entry that I'm 25,000. Excellent, guys.
Oh, sorry. Yeah.
Do you understand? Do you understand what's happening? What will I do? I will simply book the depreciation. How? The asset is continuing to remain in my books at 4 lakh. I will depreciate it over the expected time and I will divide it by 2 because it is only for half a year. Is that clear? See, this is a very roundabout manner of doing it. You could have also done very simple thing. Forget about receivable, unearned revenue, just book cash. So isn't it the same thing, guys? I will just book cash. 30th of June, what will I do? 30th of June, I will go. I will book cash account debit to rental income. How much? Rental income will become 30, cash will become 30, and I will keep on depreciating the asset the way I was depreciating it earlier. How much? 25,000. Understood how? You take the full asset divided by the tenure into the number of months that you have taken. So the asset is yours. I take it exactly at the same figure. You realize this, guys? But the only delta that, so in many books, you will find this is also what they're asking you to do. Okay, so look at the options that are given to you. All that the US GAAP is saying now, since there is a right to receive the books, debit the receivable, credit the unearned revenue. Remember, no discounting. So do you realize that for the operating lease, the situation of the lessor today is exactly what it was earlier also, right? The only delta is from the lessee's perspective. We don't want you to have an off-balance sheet transaction. So I will ask you to bring the asset and the liability at the PV. Then I'm going to ask you to apply the effective interest method, reduce the liability, reduce the asset. That's it. And you will be surprised to know the lessor will continue to do what they were doing donkey years back. I will again, the next period again, it will be the exact same entry. Do you realize this? 3 entries. I book the cash and I reduce the receivable for my books. Second, I remove the unearned revenue and I book the earned revenue. That means the rental income in my books of the exact same figure. And again, the depreciation will be of the exact same figure. Is that clear? Okay, I'm asking a question. I need the answer in the chat panel. What is the total interest income in the books of the lessor in the first year? Total interest income in the books of the lessor in the first year. What's the answer, guys? Total interest income. Now, put on your thinking caps, guys. What is the answer, guys? What is the total? Zero. Very good, Sharad, Anirban. Zero, nothing. Do you realize what is happening? What is the total interest expense in the books of the lessee in the first year? What is the total interest expense in the books of the lessee in the first year? Zero. Do you realize this? If it's an operating lease, there is no classification of an interest expense. The lessee will book one expense in its book, which is called the lease expense. That's it. There is no classification as interest income, no interest paid, no interest received. Only rental income, and earlier we used to call it rental expense, now we call it a lease expense. That's it. Is this clear? So if you look at it technically, guys, do you see it's the same thing? The rental income is being reported. Instead of rental expense, I will call it rental, lease expense. And then the only delta is I bring the lease asset, I bring the lease liability, and I then bring it down by the effective interest method every year. Vishnu, unmute.
Yes, ma'am.
Where is the interest factor coming in? Tell me. Did we pass any journal entry for the interest?
But we have calculated for the lessee the interest over the lease term, that is 21,884. There is an inbuilt interest component in it in the whole agreement.
But see, this 30 actually, this 30 has both the interest and the principal element. Yes or no?
Yes.
So ideally, if you look at this, can you see what is actually happening? This is actually equal to your depreciation plus your interest expense. Yes or no?
Correct. Yeah.
But are we calling it like that?
No, we call it as total interest. I mean, lease expenses only.
So ideally, if you look at it, this is what we are doing, isn't it? We are taking the ROU asset, the depreciation on that is 25,256. Ideally, this is the depreciation plus the interest part, right? But since it's an operating lease, I will not let you book it separately. There is no interest classification that I'm going to ask you to do. I'm just asking you to book the direct expense. We'll call it the lease expense.
Okay, that 21,884 we have calculated only for the calculation purpose, not to recognize.
Calculation of this. How would you amortize the liability and the asset? That's it. We're not going to make use of this in our PML at all.
Okay.
Is this clear?
Yeah.
And same thing for the lessor. No interest income in the lessor's book at all. Clear?
Yeah.
Okay. Anybody
Shraddha,
any questions?
I have a question.
Yes.
So
Yeah.
for the lease receivable in lessor's book, why not we discounting it? Because it's not going to receive it one year, like it's spread over number of years.
Yeah, because see, what they're trying to tell you is that is why I told you, now many books you will see that they will not ask you also to refer to this. They will, because see, the moment you discount it, you have to bring in the interest element in the books, isn't it?
Yeah.
The moment you discount it, you have to bring in an interest element in your books, which we don't want you to do.
Okay.
That is why in many places you will see that they will not ask you to do all of this. They will just ask you to do cash account debit to rental income. That's it. And then keep on depreciating. Even that is correct.
Okay.
Is that clear?
Yeah, yeah. Thank you.
No discounting. As it's just a pure rental contract for the. See, that is the reason. If you look at it, there is no need for giving the less. When we did this, we could have done it from the lessor's perspective also, right? But see, automatically for the operating lease, we are following the rental agreement only, isn't it? This is like
Right.
a rental contract in the lessor's book. That is why we don't have to give that option to the lessor.
Okay. Yeah, I
Thank you.
got it. Yeah. Yeah, yeah.
Thank you.